Well, here we are, another Tuesday evening, and yes, so much going on. I'll put the pre-show on just for a moment, just ticking up to the 8 p.m. formal start. I said to somebody in the chat beforehand, 2 months of news in a that would be normally a year's worth of news. It's been remarkable, the speed at which things are changing. So we're going to try and address some of those things tonight and think about what it means in terms of investment and a few other things too. very interesting to have a conversation on with Damien tonight. Of course, perfect timing, actually. And just to give you a bit of a context, here's the studio. Damien's teed up ready to come in over there. And all looking good. The doggies, of course, are here as well. And hopefully they'll be quiet. You never know. Sometimes they do make a bit of noise, but hopefully should be good. The bins have been collected, so that should keep them out of harm's way, hopefully. And we've just ticked over the 8 p.m, so let's take the pre-show off, and we'll start the show properly back in just a moment. Well, good evening and welcome to this live stream on the 3rd of March 2026. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thanks for taking time out of your Tuesday evening. And we're going to have a very interesting conversation this evening with Damien and try and parse some of the latest news and think about what it means in terms of investments and all of those good things. It just seemed to me that things are speeding up. Can't believe it's really a week since my last live show, and here we are in another world where oil prices have gone higher, and there's more concern about what's going on in the Middle East, and we'll touch on some of those things too, plus, of course, some of the other themes, AI and what have you. Just before I bring Damien in, let me just remind you, we're not providing specific financial or legal advice. It's the general conversation only. We moderate the chat, but feel free to throw questions, comments, suggestions. We go. If you use that Walk the World DFA, that'll get into my queue. I've enabled Super Chat, which means you can get your question to the top of the list or indeed make a contribution to what we do around here. Really appreciate those who support us via Patreon, Super Chat, or PayPal. It really helps to keep this show on the road, literally. So thanks for all your support. Really appreciate it. Right, Damien, let me bring you straight in. Hello there. How are you doing?
Not too bad. Yourself?
Yeah, pretty good. I have to say that every time we have a conversation, we say, boy, it's a bit, there's a lot going on.
So I mean, as you well know, I do my own podcast. And so I've got 4 weeks worth of slides. I've got a lot of, and I write, probably another once or twice a week at least. And so I generally, before I come on, Martin, I like to sort of go through and go, okay, what's happened over the last month since we last spoke? And I go through, and I feel like towards the start of this year and maybe late last year, I was starting to just go, you know what? That was 3 weeks. That was 3 weeks ago. That's no longer important. And now I feel like I'm going, that was 2 weeks ago. It doesn't matter anymore. It's like, if it hasn't happened in the last week, it's like ancient history. Yeah, and so, I'm feeling that with you. It's moving quickly. And, I think some of the topics we want to talk about today, whether it's the war stuff we've got coming out or just all the stuff that's going on with AI and the different software stocks, it all feels like it's moving incredibly quickly.
Yeah. And it's therefore, as I often say, signal and noise becomes critical, right? Because there is a sort of perhaps a knee-jerk reaction when a sort of a huge piece of news like the Iran situation comes out. Some investors are looking to try and trade the volatility. And we've seen quite a lot of that. I think some of the moves in various commodities are partly trading volatility. But then if you're actually also thinking about building investments for the longer term, trying to look beyond the noise and say, what does it really mean? What are the different potential outcomes and how do they potentially impact the way that I think about my portfolios becomes quite important too. And I've been around long enough. I mean, I can remember the market crashes of the the 70s, 80s, 90s, and 2000s, and some of the news that created it. I remember the earlier oil crisis and what happened there, and we had petrol rationing and all sorts of things at that time, and it created significant changes and turmoil in the markets. But I suppose you would have to say, well, actually, if you look over the long-term markets, are still were at all-time highs pretty much until last week, right? So,
and they're not very far off.
No,
Joe.
No,
We've sort of,
no. And of course,
sorry.
I was going to say, we one of the other things, there's a rotation going on at the moment. So, the index might be quite strong, but in fact, defense stocks are way up. Some of the energy stocks, not so much. And therefore, trying to read the room, as it were. Financial stocks took a really big hit last week because of the cockroaches in the private credit market that are coming out. We've got the AI story and what that means, and how much is signal and how much is noise and how much is real. The COBOL revolution. IBM stocks hit the various other software companies who now suddenly think, well, actually, you can just get AI to do that. So there's a lot to try and parse here. What's your sort of starting point, Damien, for when you've got this sort of amount of craziness going on? How do you anchor yourself to something?
Yeah, earnings. Earnings is what I'm coming back to. So they always talk about markets climbing a wall of worry, and there's always stuff going on that markets are worried about, and can it go wrong and things like that, and now is that as uncertain. I'm same with you. I was I think early 90s when I first started working in investments, and so it's whatever 35 years ish. Um, I can't remember a time as uncertain. Like there was times where there was some, certainly, financial crises and things like that. But in terms of the part about uh, the path forward, even though you might have thought people might have been thinking wrong, there was sort of like a consensus over what people thought was going to happen. Whereas I think there's a lot of stuff going on now, which is like we have no idea. Like, is Iran going to end up a failed state? Are there going to be somebody else take over? Is the US going to win? Is there going to be somebody going to strike a deal? Is the Revolutionary Guard going to keep taking pot shots at other people's airports? There's a whole range of different outcomes that can come, which I think you can't take a huge bet on either of them, on any of them. And one of the things for people who are wanting to play volatility, um, I wanted to get in before, and then let me come back to actually answer your question. But you're talking about volatility and playing it. One of the key things you really got to watch, two key things to really watch now is the level of the uncertainty you've got is, well, I don't know what's going to happen next week. There could be new tariffs on, they could be off, they could be, the Supreme Court's, against the Supreme Court, they could be attacking other countries, assassinating leaders, picking a war in Greenland, who knows what's going to happen. So there's that part of it. Okay, how much do I really want to invest on that idea that, yeah, whatever's going up now is going to be going up, or whatever's going down is going to be going down? That's one part. And probably as concerning, if not more concerning, is the fact you see, things like the betting markets all of a sudden start on these huge bets just before the whole firing starts of missiles, and stocks that rally. Then there's announcements out of the White House that all of a sudden make the stock, then the stock jumps 10%, and then all of a sudden it jumps 50% as the announcement comes out of the White House and things like that. Is that there's clearly either just very leaky and insider word coming out of the White House, which is it's possible that it's all just I guess down to incompetence and badly run processes, but it's also likely that they're doing this on purpose, and they are front running these, and they're like, yes, we're about to do this. Where can we go and make money on this beforehand? Where can we front run our own political decisions? And so if you're out there trading volatility, what you have to worry about is there's people out there who are taking the other side of the bet that I'm on. They know something that I don't know because they've got inside, I'm now dealing against, Jared Kushner and Trump's kids on the trade, because they know what's going to happen in what Trump's just about to tweet or what he's about to announce. So, if you want to play volatility, I'd be, I'd caution you against trying to play volatility too much at this point, and certainly limiting the size of what the bets you're going to be doing. But I do think there's what does come out of volatility is this idea that if you have a view about where things are going, and you can have a relatively well articulated, right, these are the types of companies I want in this environment, these are the types of companies I don't want, then I can look and I can go, right, so whole software sector's just been smashed. These are the types of companies I want. I'm looking to buy those ones while it's down this week or next week. And the ones that I don't want, well, yeah, they might be down 50%, but I'm not touching them still. It's a matter about having that basis for what stocks you're looking for and what prices you're willing to buy them at.
Yeah,
so
and
a long way of getting around to what and then we'll bring out this chart.
Yeah, just one little observation. I think this idea of some people front running the crypto story is a really good example of that, right? There are a lot of people in the US government who made a lot of money creating their own coins, for example, as well as actually positioning ahead of those announcements from last year. And, crypto had a big run up and it's now come significantly back. Funnily enough, quite a few of them have made a lot of money in that process. Now, that's a good example of what happens when, in fact, the insiders are actually trading.
Yes, exactly. And the rules around those insider trading and making profits have just basically been, that was the one of the first thing they did was fired all the inspectors general. And so at the time, there was a little bit of an upcry over that, and there's obviously there's no more gone. But that's the first thing you want to do if you want to break the rules is get rid of the umpires, because that will much easier to break the rules when the umpires aren't there, or you've installed your own umpires who report to you.
Yeah.
So yes, but let's come back to this the basis
Yes.
why I'm still got a reasonable amount of equities. So this is the forward earnings per share you get out of the US. I mean, it's pretty. I'll use the US just because it's a nice, easy graph to show, and it's very similar when you look at it on a global basis. Now, for anyone who hasn't seen this before, I come back to it all the time. The blue lines is each year. So this sort of third blue line from the top, that's your 2024 years. So expected these numbers, and over time it sort of went across and eventually ended up down. This next blue line is the 2025. So we saw as Trump came out with the tariffs, those earnings really fell over the most of that year, and then we saw the rise over the second half, and then this is what we're looking at for 2026 so far. Now the red line is the average, the 12-month forward average. So basically every day that goes past, you get one more day of 2027 and one less day of 2026 at the moment. And so that's the real key to me, is when that red line is rising, the market is almost always on the way up. When the red line is falling, it's almost always on the way down. And if you look back at this, this is a 20-year history I've got here, and there's plenty of other series you can put within this. But on this 20-year period, there is not too many periods you can look at where the increase in the speed of that red line going up is as fast as what it is today. And so, yes, there's uncertainty. Yes, markets are expensive, but there's actually 15% growth sort of factored into the market for 2026 and 16% for 2027 post the reporting season. So we've just been through this reporting season, and analyst forecasts have gone up as they've been through and have seen companies report. Now this is in aggregate across all companies in the S&P, and it is market cap weighted. So the bigger stocks in the index have a bigger effect. So if you've got the AI stocks, for example, the Microsofts and those guys upgrading their earnings, and then a whole host of 100 small companies downgrading their earnings, well, the Microsofts and that are worth more than 100 companies, and so the aggregate line goes up. And so that's the part I'm sort of coming back to in terms of saying, where the rubber hits the road on this is the big concern we have with most of the AI side is, will we end up, and then we'll talk more, I'm sure, about this Centrini piece that came out. Will this end up in so many job losses that what we see is companies then start losing out because you're heading into a recession, and they're going to spiral out of control. So that's a potential down the track. I'm sort of looking at every single stock and every single sector and saying, okay, first, how much are they affected by AI, and then secondly, where's that going to go? So there's basically three spots it can go, and a mix between them. So you're going to save, for companies that are going to save costs, they're going to save a bunch of workers or whatever the costs they're saving at the bottom end. They're going, okay, so I've just saved a whole bunch of costs. It's going to go in one of three places. It's going to go into paying the wages, higher wages. So maybe if you're in an industry where maybe it's a lawyer or something like that, where they don't need as many assistants anymore, and they can actually just keep charging or charge higher rates, so that the end client still pays, $10,000 or $100,000 to get their legal work done, but the lawyer just didn't need to use as many resources for it, and his firm doesn't pick it all up because it's a lawyer's relationship or whatever it is, and so maybe it's these higher value employees who end up capturing more in higher wages is one scenario. Second scenario is it ends up being lower prices. So, industries that are very competitive. You end up, yes, that everyone saves money, but then they all go away and compete. They all go down, lower their prices and push it down, and the end consumer ends up winning through lower prices. It's the second way. And the third way is where you get, say, an oligopoly or something that's a bit more complicated. And what happens is they manage to save all these costs, but they actually just keep their costs, they keep their revenues where they were, or raise them. And so it all ends up in higher margins. And so that's the sort of three options. A lot of companies are going to be a mix of all of those, and some will be equally, and some will be more on one or more on the other. But really looking at it through that lens and trying to say, where's it going to go? And for the large companies at the moment, it looks like ending up in higher profits, more so than those other areas.
Yes, and it's fascinating when you look at the concentration amongst those larger players and their ability to drive their profitability higher. Now, whether that's simply because the costs of goods are a little lower, or whether they're being a bit more efficient, or whether they're actually just able to press their margins. And I'm fascinated by the margins growth. There's been margin expansion rather than contraction over the last few years, despite all of the inflationary stories and everything else, right? So big players can muscle in. Some of the smaller players, not so much though.
No, that's right. And industry by industry, I think I'd say, I just want to make sure that whenever you're doing this, it's about what happened last year, not necessarily what's going to happen this year. And that's where I think, so as I said, it's 3-week-old news now, so it's almost it's yesterday's fish wrapping. It's but the software stocks suffered some a pretty decent fall, and a lot of that for me is coming back to that idea about, well, you just need to be really careful about what do they do. And what was a high quality company last year or the year before does not necessarily mean it's a high quality company this year.
Yep.
And I think for me, so the way we invest at Nucleus in our active funds is we put everything on a quality versus value matrix. So on one axis we've got value, and on the other axis we have quality, and we're basically trying to invest what we call under the curve. So we want to find high quality companies that are cheap. Now, they're very hard to find. You very rarely get them. But what it does mean is you can say, well, I'll take a really high quality company, and it might be a little bit expensive, but I'm still happy to buy it because it's really high quality. And then it's saying, well, yeah, but if I'm going to buy an average quality company, then it needs to be cheap. Otherwise, it's just not even worth buying unless I can pick up an average quality company for quite cheap. Now, with quality and value, it's sort of an interesting mix of companies in that I'm basically taking two bets. You're taking one bet on quality, which is saying, okay, if I'm buying a high quality company, then it's going to keep being a high quality company. And then if you're buying it on the value side as well, if I'm buying a company that's, say, average price, I'm betting that it'll go up, it'll actually become a bit more expensive because it's such good quality. Or I'm buying a company that's cheap, it's going to become less cheap. So I'm sort of betting on things changing. So it's sort of like a mixture between betting on things changing and things staying the same. So the long story behind that is, where things go really wrong when you have this framework is where you buy a company that you thought was high quality, say a Kodak. You go through this Kodak moment where you buy a stock where you're like, yeah, these guys great. They produce film. Everyone always needs film and all that type of stuff. And then 5 years later, the digital photography is really taken off and nobody uses it anymore. And what was once a high quality company is now really struggling. And so that's where you go from saying, oh, I'm buying this company that's I'm buying it and paying more than what I should buy for it. I'm buying an expensive company and I'm paying up because it is really high quality, and I'm betting on that they're going to keep going that growth. And so you get a double whammy effect because it goes from being, yes, it's a bit more expensive than the market because it's such high quality, to now it's cheaper than the market because everyone's recognized it's low quality. And so you lose out on that, plus you lose out on the quality part as well, and the earnings fall. And so you sort of get this double whammy where you can lose a lot of money if you're not watching. And so the most important thing for me, for all the companies we're covering, is, are they still a high quality company? That's what we're always asking, time after time after time. We bought this because we thought it was high quality. Is it still high quality? And there's a whole bunch of these software stocks that their earnings look like they're high quality, but now it's the bit looking forward, and what everyone's doing is saying, well, if you're just a wrapper around stuff, so if your real benefit is, you get to put, you've got, say you're a Salesforce or someone like that, or a HubSpot, some of these companies have got hit pretty hard where you're like, yeah, you've got a reasonable CRM product, but actually the real value in those was people buy it for the CRM and then they're like, well, actually you can send my mail for me and you can do my analysis for me and you can do these, you can run my website for me. And yeah, you're not the best website company. I wouldn't have bought you for that. Or you're not the best mailing company. I wouldn't have bought you for that. Or you're not the best, analytics company. I wouldn't have bought you for that. But I've already got you for the CRM. Everything's integrated. It's great. I don't have to worry about connections. I'll pay up for it. And those companies charge. Once you sort of go, you bought their initial product for a reasonable price, and then you're like, yeah, I just want that upgrade. They're like, oh, fantastic. Let me really get you on that. And so really their benefit is one good product and then a wrapper around all these sort of average quality products. They're the ones that are now have got a problem with their business model because the linking between sites has become a lot easier. What AIs, most sites, if you want to talk between, site A and site B, let's say it's a MailChimp and something else, and both of them have APIs that are well written and detailed and all that type of stuff like that. But they're both hundreds of pages long. I have to go to a program. I have to get them to program it. Then the company goes and changes. I've got to get them to upgrade. There's this whole process and a cost of keeping them up and running. But you know what AI is really good at doing? Reading what the rules are, reading somebody else's rules, reading up where to cross over, and that's the type of stuff AI is just very good at doing. And so that whole part about being a wrapper all of a sudden disappears and you lose that benefit. And so that's where coming back to these software stocks is going, okay, well, I know I don't want those ones, but there are other ones out there that have got genuine data and genuine information that they hold. Now, actually, they're going to benefit from AI because the more people that can run, say there's companies out there that have, we've got one in our portfolio that's got some, a lot of a lot of data about the history and medical tests and programs and FDA approvals and all that type of stuff like that. That's all proprietary data that they hold in the system. AI stuff loves it. They want a good source of data. They can't go and scrape the web and get all this information. Actually, a company like that has actually just become more valuable because now there was only a certain number of people who could analyze the work they had and had the technical capability to do it. Well, AI has actually just increased the number of people who now have the computing and programming skills to actually get in there and analyze that data. And so for us, it's very much about saying if you had a commodity bit of data, so you were just very good at screen scraping government websites and public information, well, you're probably going to lose out in this. Companies like Canva, companies like Adobe, where what they did was very valuable. I don't want to say what they did it is very valuable, but in the end, people have those products because they're like, well, I want a logo and I've got this idea or someone has done something for me and I just need the files that come out the other end, or I need the pictures or the videos or whatever it is that comes out the other end. I don't care if it's done with Adobe. I don't care if it's done with Canva. I don't care what it's done with. If AI can do the whole thing and it doesn't even use any programming within it, fine. I don't care. It's I'm just getting a logo done. I don't care if it hasn't been done through Canva or hasn't been done through Adobe. And so they're the companies that are in some real danger in that the product they're doing is just not you're just going to lose people because AI can just do the whole thing, the whole process for you. Mm. And so we've just been going through every single one of these and going, let me get my list I've got a list here of some other things. So just coming back to where is the value within it? Are you doing stuff or are you just connecting? Have you got sort of all-in-one systems, or are you, do you have stuff that's just really just commoditized? And so that idea that what is a core feature and what's not. Sorry, let's get rid of that one. Is where's the level of abstraction and a bunch of other things. Who's increased their barriers to entry and where have you lost barriers to entry? And so that's sort of very much for us. Part of this new. How do I think about companies? And I can't assume what was the case last year and the year before is going to be the case going forward.
Yeah, very interesting. And we'll come back to the Iran situation and oil shortly, but I just wanted to sort of explore this AI axis a bit further, Damien, because as an entity here who has unique data. My surveys are running all the time. I've been running them since 2001. And what I'm finding is that I'm getting more and more interest being expressed by people who say, "Hey, I've got these AI tools. Can I run it across your data?" And so when you've actually got something that's a unique potential set of insights, the tools potentially are actually quite powerful. But I can tell you also, as somebody who's been experimenting with the AI story and the AI tools for some time, two observations. One, a lot of the AI tools will almost tell you what they want, what they think you want to know. So it's a bit of a circular argument. And by the way, if you run the same query on the same data, you might get a different result. And two, very interestingly, and this is where it comes to a broader debate about AI, is AI really bringing new insight to bear, or is it really just a smarter, faster, more powerful search? And over the last 2 or 3 weeks, there have been a number of articles coming out across that spectrum where at one end they're saying, no, this is absolutely revolutionary. And, we are seeing sparks of intelligence and 1 and 1 equals 3 that you never saw before. Or is it the other end of the spectrum, the argument, say, no, this is just really, really smart, really, really more sophisticated search, but it's not actually creating new stuff. It's just spewing stuff back. And in fact, because it's spewing stuff back more quickly now and with more hallucinations built in, actually, you're not creating more insight necessarily, you're creating more noise. I don't know where on that spectrum we actually are with the AI. I suspect that the truth is it depends, but it's fascinating to see this playing out.
Absolutely. And look, we do a lot with AI within ours. We've got a lot of processes which we're running through AI systems. I would not let it anywhere near a trading button, but I think it's excellent as as an intern. Here's my pretty close to unpaid intern. It's that can do stuff, and if it's given the right instructions, it can come up with some quite good stuff. And if it's given some poor instructions or very little, then it can come up with absolute rubbish. Now, I think there's a couple of things I'd note with this, and I mean, everyone's in a. I feel as if, particularly in the programming side, there's this Cambrian explosion going on, and everyone's in this mild sort of part of, I don't know about panic, but certainly unease. There's a lot of unease about, my God, what are other people doing with this? Are people doing some great stuff? And so, and my take is I think what I think's right is there is a definite J curve to this. So, when you first start using it and you're like, the example we were talking about before, there's this statistical function. I remembered, how does it work again? Can you help me? And it comes back, fires it straight back to you, and here's what it is, and here's how to use it, and here's a quick program. Here's a bit of Python you can use to slot in. You're like, fantastic. How good was that? That increased my productivity greatly. That's the start of this J curve. Then you start going down though, because you like say, well, actually, you've done such a great job with that. How about you do it for me? Can you get it and build it and integrate it with these bits and pieces and go and do that for me? And you find that if you've got something in particular you want done, you can beat your head against the wall and go, no, I didn't want you doing that way, or I told you to do this, and you started doing it right, and then you've wandered off and done stuff, everything wrong, and you end up in these parts like that. I think there's this real push now, which is actually changing the nature of the way people are programming, and one of the ones it almost sounds like a joke concept, but this idea that there's this Ralph Wiggum, it's called, which is, for anyone who's not South Park, a Simpsons fan. He's basically a bit of an idiot kid on The Simpsons, but he's stubborn. And so there's some of these programs. There's a Ralph Wiggum program which is basically based on that whole idea. Look, I've got this AI agent, and you know what it is? It is pretty stupid, but it's stubborn and persistent. And so if I can give it a problem with clearly defined inputs and clearly defined outputs, and enough guidance and where the sides are, I can just let this thing at it, and eventually it'll come up with the right answer. Yeah, it's going to have 1,000 wrong answers, but eventually it'll get there. And there's a certain element to this, which is the part, and this is where I've sort of been working on trying to work out this future of this AI and where's it headed, because if that coding works, and there's enough people out there doing it who say it works enough, used it a bit in processes where I think there's a certain uh, what we've been finding is that you need an external validator. You can't sort of if you give it any sort of okay, you do these 20 calculations, and by the end of it, here's what the answer should be. It does 19 of the calculations, gets the wrong answer, and goes, oh well, let me just insert what I know the right answer is into the and whereas if you've got this external, you get to the end of the 20 calculations, tell me what you got, and I'll tell you if you're right or wrong, and then go back and try again, and so you're not letting it cheat. It's much more successful. It can take a long time, can sit there and churn for 20 minutes to come up with the right answer. But it's that part where you can be surprised at the whole. If you sit there and watch it, you're like, oh man, this thing's on completely the wrong path. It's gonna, whatever it is, and you sit there and get annoyed with it, or you can just ignore it. It's on a different screen. I'm working on a completely different problem with a completely different AI, and come back and go, yeah, that's succeeded. The other part is where ChatGPT was really making some inroads, and why it was sort of the leader of the pack for a while there, was it was sort of taking larger and larger contexts and basically going, if I give you 1,000 instructions, Martin, some of those instructions are going to contradict each other. Which one do you listen to? I give it all this long list, and ChatGPT was building a model that was quite good at taking quite long context with a lot of information within it and coming up with something that was more reasonable than some of the other ones. Where Anthropic sort of jumped ahead is going, well, no, what we're actually better off doing is 100 different models, each with 10 instructions, and those 10 they know how to run those 10 instructions. And then we can get better answers if we're using all these individual agents, which is like, your job is just to do this. And then once you've done it, I'm going to have something else come in and check it and make sure you haven't made any of these mistakes. And the third system is going to come in and check the answers of the second one. And then only then am I going to say, yeah, now that's a good enough answer. I'll send it back to my process. And so it's completely different. And it's a brave new world. And I think that's where everyone's like, I'm not quite sure where this is going, but something's definitely happening, and there's enough of an outline of where it can lead that you're seeing genuine company cutbacks within this programming sector. Now, does it mean there's going to be no software people left? No, not at all. There's going to be software people left, but it's a bit like, I thought quite a good analogy was, your accountants before the calculator. So before the calculator, had all these accountants doing manual maths and adding it up and checking each other's work and all that type of stuff like that. Well, now I need one because he's got a calculator, or maybe maybe I needed 50. Now I needed 10 because I've got calculators. And then Excel came out, or Zero or MyOB, and now I just need one. And now it actually only needs to be a part timer because we've improved stuff. So that type of part is, yes, I still need somebody, but they're just going to need to be they're going to be so much more productive that I'm just going to need far fewer of them. And I think the cuts you're seeing at the moment amongst most companies, from what I can tell, is all the junior people. We're just not taking more junior people on. And it's all about the stuff where it's, there's anyone who's worked in coding or bigger companies realizes, yeah, there's a handful of people that know what's going on. And then they do the core of it, and then they farm out all the boring parts to everyone else. Well, now they're farming the boring parts out to AI. And so those people have now made themselves way more valuable. There is some question about where is the next group of people, to replace them when these guys retire, and a whole bunch of other philosophical questions. But I do think there's enough in there that's saying, yes, I've seen plenty of examples where AI gives completely the wrong answer and cheats and lies and steals and does everything it shouldn't do. But there's enough out there to show that if, with the right guidelines, it can also come up with the right answers. And it's really about managing this new form of programming, which is, a lot more hands-off and a lot more managerial. Like, it's a lot more about saying, well, if I'm paying for somebody to build my house and I've got the structural designs and I've agreed on them, then I'm not out there telling the bricklayer how to lay every brick and make sure that everything's, it's basically, well, as long as it fits this criteria, I've just got to rely on the fact that I've got these things doing it. And so, and I think that's where the AI side, to get out the other side of that J curve, is a bit of just a new form of programming. And it's in flux at the moment. It's not finalized, and it's definitely not what anyone learned at university, because it's really only been around for 6 months. And so, and seen some quantum leaps just in the last, month and a half. And so, yeah, I think it's fascinating.
It is fascinating.
I forgot what the question you were first asking.
No,
I feel
no,
like I
no,
ended
no,
up somewhere different.
no, that's good. The interesting observation, there was a research report that came out quite recently talking about the chaos that's being created by agents, effectively, the AI agents starting to talk to each other and essentially almost beginning to play games with each other and actually adapting and adopting behaviors that are actually exactly the same defective nature as humans. In other words, we're just replicating the same inefficient stupidity and fighting each other. So actually, the other observation here is, nobody quite knows who's going to play out, but that as the complexity increases, the chances are we're going to incorporate into this new mode of operation precisely the same defects that we've had for generations.
Right.
It's just going to be
Possibly.
quicker.
Yeah, that's right. But look, a couple of things to note on that. One is just the last one on the sort of the physical side of it, is there's a lot of these things popping up all over the place called skills, which is basically in the end, it's basically prompt engineering it's open source prompt engineering. And so you can go, I think it's skills.sh is like one of these places, but basically they're it's ways as you're programming to go, okay, somebody's already written the prompts to go, I need to have a security review. Here's the checklist of everything that needs to go into a security review. And the good open source ones that are sort of being built on and added to from everyone else is they are then going, okay, this just stuffed up and it started doing the wrong thing. Okay, let me go and fix it. Let me put something else in. And it's sort of a group project, so to speak, of people adding to it and going, how do we engineer these prompts? So that's one part that's sort of, within that. The other part, so what was the question again? What were we talking? I had another important point I wanted to make. We were talking about.
So we were talking about the agents talking to each other and the relative defects that could come from that.
Yeah. So I think there's some of that is that prompt engineering part of it. Oh, yeah. That's where I was going with the other part is when you're thinking about costs and this. So if you want to run the Claude, I think it's about $300 a month Aussie for the sort of more advanced version that lets you churn through lots of stuff. And that sort of goes out and can sit there and run by itself for 20 minutes or half an hour doing all this stuff and asking questions and using AI and all those things like that. And you go, okay, so that's not it's not an insignificant cost. It's $3.5, $4 grand a year in terms of what you're spending on that. But if you can replace an IT person with that, or two IT people with that, man, it's a bargain. I've just replaced $100,000 salary with $4,000 worth of costs in that. The cost that's using is not the same costs as it's building the models. So this is more the processing. And I think I spoke to you, I feel like it must have been a year or two ago, we spoke about this strawberry, about how the cost was flipping between that. So, and it's about this, the post-processing and the other things that are being done with those. And so it's actually sort of led to a bit of a jump in the demand for CPUs. So there's a lot of demand out there for the general processing units that NVIDIA's got, and they're still definitely running hot, but also some of this other stuff that's out there. And so, as I said, it's interesting that the part where you're like, well, if you watch some of these agents and what they're doing, and you're just sitting there go, oh God, this thing's it's sitting there wasting my resources, on the wrong path. But if it only cost me $300 and it cost me $300 for in a month and it saved me $10,000 for what I would have paid for some employee to do the same thing, then actually, oh well, who cares that it wasted $100 worth of resources on completely the wrong path? But who does care? Well, the person who's providing those resources, they care, because that's and so that's the one where it's about saying, well, where are while these agents are destroying some areas of software, actually they're wasting time and spending a lot more in other areas. And a lot of this is just that whole. If you're looking for business cases for why they keep building all these data centers, well, that's the business case. If I can replace a $100,000 employee with a $300 a month cost, well, I need data centers to do that, and that equation is going to get done. Every single time, people are going to say yes. Sold on that. I'll absolutely replace $100,000 of salary with $4,000 worth of capital cost a year.
Yeah, and that, of course, suggests that ultimately there will potentially be some productivity improvement, although, as someone said in the chat at the moment, a lot of the reports suggest that productivity improvements are hard to see when you actually start to look at this in detail. And
a lot of people are on this J curve, and
yeah.
I'm not like I think you come out the other side up higher. And there is lots of companies out there talking. Sorry, not lots. There's some out there that are talking about it. A lot of the people who are talking about it are also selling courses to try and convince you to do stuff. So they're not all they're not all necessarily got your best interest in heart, or they're certainly interested in collecting your money. So but there are some reasonable sized companies out there that, and look, Claude itself is probably a good example of that, and Google, within Google, and there's a couple of other examples I've got of ones out there who do seem to be genuinely using the AI in this way, that they're taking themselves out of the programming process and leaving that to the AI to sort it out, saying, well, as long as you come up with the right answer, as long as it's fast enough, I don't care how you get to and as long as I can check that I can keep you in that sort of lane and make sure you're not doing it, then it's up to you to come up with the programming. Whereas I think if you come into this as like, no, I know exactly how I want this done, and you have to do it the way I want you to do it, you're gonna be very frustrated. It's I think that's one of my New Year's resolutions is I've got to stop swearing at the AI.
And I'll just make one final point on the AI axis here. Microsoft was talking some weeks ago about the fact that they were using AI more in their development cycle, right? And then they put out a series of updates with major flaws. And of course, some people are associating those major flaws with the fact that they're perhaps using AI a little bit more than previously. And if you want another example, CBA has come out recently and said they've got a problem with about $1 billion worth of their mortgages because the AI that people used were able to create documents that CBA couldn't detect as fraudulent documents, and therefore they lent. Right. And it looks to me as though CBA may not be the only financial services company who is actually effectively, possibly, now lending against fraudulent documents, because the AI is good enough to be able to create documents that are, ability to be able to actually get money. So there are consequences of this that I think are still not being fully thought through. And by the way, sidebar, this is now probably going to be a lever that the banks and maybe the government will push people towards using digital IDs to try and associate their information with digital IDs, which means you can't then get fraudulently forced to make loans because of AI. So look, there's a lot of confusion here. And my point is, we're in the foothills. We're absolutely in the foothills of where this is playing out. And anybody who claims that they can clearly see the future endpoint of where AI is going is kidding everybody, including themselves. Nobody knows, right? But what we do know is, one, a lot of money is being spent. Two, a lot of that money that's being spent won't necessarily ever pay back. Three, some will, and some will predominate into the future. And four, the energy story, which comes back to the Iran situation. Energy story becomes ever more critical.
Yes, and we spoke last time about the energy side. In that, my big picture view is that there's plenty of energy we can definitely afford. If it tripled in size, it's not a big deal. To 1 or 2% increase or whatever in the size of the energy you need. But that's a big picture view. In the short term, that's wrong, because in the short term, we need to connect all these data centers to the grid, and that's really hard to do in a fast way. And we spoke about how the grids in the US are that whatever it is, 99% of the things aren't getting connected because they have to do studies into it. By the time you've sort of done the study about you've just finished your study into what's going to happen when you connect this to the grid, is like, well, actually there's 6 other things that have been connected, and so now I've got to redo the study and whatever it is. And so and this is actually where China, not intentionally, I don't think, but they've got this real benefit in that most Western developed countries, the energy grids have not been growing for some period of time. And so it's all about stability. And the whole focus is saying, don't let the lights go out. We want to make sure that everything's stable and that, you want to add something, we need to do a 6-month study into what the difference is going to be. And you want to take stuff away and, all this stuff like that. So it's a lot of regulation around making sure that the energy grid works the way it's meant to work. In China, look, they still have those types of things, but because they've been growing the grid so quickly, it's been about, yeah, having a stable grid, but also a growing grid as fast as, because they've needed so much power. And so they're just, the regulation is set up to be very friendly to adding new things because they've had to add new things. Whereas most developed countries just haven't had to add new demand in the way that these data centers are using it. And so they're just not set up to do it. And that's a lot of the problem, I think, is not around the magnitude of the problem, it's around the speed of the problem, which is these guys want it done tomorrow because every day that they don't have their data center up and running, they're losing, potential. Well, they're not losing the money, they're just not getting the hundreds of millions of dollars they might have got if they're up and running. And so they want to be going, everything's got to be done as fast as possible. And so yeah, I don't have as much concern with energy over the long term about do we have enough energy? Will it blow out energy costs and all that sort of stuff? I'm like, no, we're fine. Because I just don't think the increases, we're talking about, even if it tripled or quadrupled in size, it's 1 or 2% per annum, for the next 10 years and you've got enough. But it's more that speed of connection and then all the critical points there. So it's about saying which of these technologies are like, um, you know, it's just it's a bit part that connects something to something else on the electricity grid, some sort of transformer or something like that. The technology is just not that difficult, but we haven't got enough of them right now because everyone needs them, and so the prices shoot sky high. It's like, well, there's nothing stopping that price going back to where it used to be. We know we can make them at that price for a profitable level. So if you're invested in that company, you don't want to be paying over the top for it. But if you're invested in a company that actually has something genuinely new and exciting and all that type of stuff, okay, or it's about to become a market leader in one of these areas and grow its revenues, then yeah, maybe I'll accept that their revenues might be elevated at the moment, but they're going to keep being high. So say it's just the ability to, I don't know, air condition specialist cooling systems, say for these data centers. It's like, yeah, if you're a market leader in that and you've got these specialist cooling systems, you're probably going to need to keep building those over time. And so, yeah, maybe you've got prices that might be double what they should be at the moment, but they'll eventually come back to levels you'll make reasonable margins on, and you'll be a good company. Versus the guy who's making transformers, and right now you're selling it for 10 times the price you usually sell it for, but it's going to go back down to that price that you'll barely break even at a few years ago at some point when somebody builds some new factories for these things. And so, yeah, just trying to distinguish between those companies, I think is the key at this point. Is don't where are you getting excited in the boom? Just try and find the companies that you think will still have something when the boom's over, as opposed to the ones where when it's all over, they're left with nothing or a subpar business.
Yeah, and in fact, if you look carefully at the AI pantheon of stocks, some are quite strongly up, others not so much. And I do think there's more discrimination than previously in terms of looking at the business models of different providers and how they're playing. I'd also make the point, Damien, that if you look at the S&P 500 over the last little while compared with the equal weight S&P 500, actually it's the equal weight that has actually done better. Yeah, because there's been a rotation away from this massive growth spurt that we had in AI. And I would suggest that is likely to continue because not everything attached to an AI label is going to necessarily perform in the same way.
No, that's right. So the Halo companies, heavy assets, light on obsolescence is your our latest acronym. Materials, industrials, consumer staples all boomed. Yeah, look, I don't know. I sort of there's I wouldn't get too excited about some of these. I know the materials sector in particular has boomed, and I do have some concerns over that. I do think there's elements of the material sector where they are short on what they need, but there's also elements where it's like, well, there's plenty of this stuff around. We spoke about silver last time. There's plenty of it around. It's just a matter of them building some more mines. We know they can do it. they're out there. I think copper is very much in that same part. Yeah, we need way more copper for all this stuff, but actually not that much more as a percentage of in terms of world growth. Nothing like the amount of copper, extra copper we needed when China came on board. We needed we needed to double the size of the copper. Now we need to, as China came on board over the 2000s. Now we probably need to increase the size by 30%, maybe not even that, maybe 20% increase in the size of the sector. It's like, yeah, it's reasonable, but 20% over 10 years is like 2% per annum. It's like nothing. So yeah, I just sort of I'd be wary about getting too excited about these. I come back to the lithium story often, that because that's been up and down and back up again recently. Um, that's the one where I look at the commodities in two ways. One is you're a commodity which is like an iron ore, you're a copper, you're a zinc, aluminium. One of these ones where there's not that many mines around. The mines nowadays tend to be really big. They go through this period where the price goes up a bit, then somebody builds this new mine, and the new mine takes sort of 10% of the world's demand or something like some massive amount, and then they get lower prices, and you sort of rinse and recycle and go back again, and you sort of just a typical cycle of these things where prices go up, prices go down, and don't get too excited when they're up, and don't get too upset when they're down. And just trying to just really watching when are these major mines coming on and when are they not. That's sort of your key to some of those assets. Then you get ones like lithium, which is very different in the sense that we need so much more of it so quickly. There's plenty of it out there. The mines are all increasing at 30% per annum, the amount of production they're doing. Demand's increasing at 30% per annum. And so if demand increases by 33% per annum and mines only produce at 27%, all of a sudden, it's a massive boom. We've got this big gap of how much lithium we need. And then the next year it flips around and mines increase at 33%, but demand only increases at 27%. And all of a sudden the prices crash. And so I sort of, yeah, it's trying to say when I'm talking about materials, which material am I talking about? Am I talking about just a normal boom bust and what's it being used for? Is it mainly old school stuff? Or is it one of these ones like lithium where, yeah, it's got this massive growth profile, but just because it's got a growth profile doesn't mean the price is going to be going up all the time. It's about how much supply is coming on, how much demand is needed, what are the substitutes. When the lithium price goes to, whatever measure you want to use, but $100 in, then all of a sudden people want to use sodium batteries, but then it crashes back down to 10,000 and it goes down to 10, and all of a sudden it's like, oh, well, actually, I don't need the sodium batteries anymore. The lithium's, far better and far more useful at these prices. And so, yeah, there's just like, yeah, so I'm circumspect about materials. I think far too much excitement gets put into them, and usually at the wrong time. Like usually, I feel like it's what we're talking about, insiders. The insiders have been in on a trade and the thing's shot up and they're like, okay, I need to get out of my copper trade now. I need a bunch of people. So let me start writing articles and pushing out and, blog posts and all this stuff about what a fantastic idea copper is and all that type of stuff. And then once I've loaded out of mine and the price starts falling back again, then I'll be buying back and starting the whole process again.
Yeah. And I will make the point, I made it before, I want to make it again. The talking heads that you see on pretty much all of those finance channels and all of those articles, they are people who've taken positions and are effectively,
myself included.
Yeah, well, that's true. Yeah, but the point is, they have already taken positions, and so they're not giving you objective, independent, methodically thought through advice so much as they've actually got an interest in the position they're taking. And I'm always skeptical when I hear people saying, do this, do that, do the other. What I say is, check it out.
Yeah. And I'll tell you this in my defense. I'll tell you what my defense is we sort of manage hundreds of millions of dollars, but we invest in the top 1,500 stocks globally and government bonds, which are trillions of dollars. Like, as much as I'd love to be able to say that I could move the Microsoft price. I can't move the Microsoft price in any meaningful sense of the word. Okay. So I'll tell you what I'm invested in, but realistically, whether you buy it or not, it's not going to make a difference to me. You're not going to move the price. I'm not going to move the price. No. The difference is when you get the big fund managers who do own 5% of the stock, or they're investing in small cap stocks and they do own, 5 or 10% of that stock. They move the price. And when they want to get out, they need somebody to take the other end of that. And that's why they're often on those shows and often talking about XYZ mining stock, fantastic. I've owned it for 10 years. I've made all this money on it. Now's your chance to own it. I've got something, if I've got someone I want to sell, I'll be sitting on the other side of that. But that's, yeah, I think there's, yeah, be aware of what people's, who's giving you the advice, myself included.
Yeah. Well,
Yes.
we say caveat emptor, and I think, when you're thinking about investing, you've either make a decision, right? You've either got to say, okay, I'm just going to outsource that whole thing to, a Nucleus Wealth or somebody to look after it for me, and I reckon they're going to do a good job. Or if you start doing it yourself, well, then you're actually taking on yourself a burden, not just at a point in time, but as we've said, things change, right? So by definition, you're going to have to keep across the various nuances that are going on across the market sectors that you're interested in to make sure that what you've got is a portfolio that's still appropriate for what's happening. And I sometimes worry, Damien, that people actually, set and forget. They sort of assume that what was true 3, 5, 7, 8, 10, 12, 20 years ago is still true today.
Yes.
And we know it's not.
Yeah. And the most important part of that is, as I said, in certain industries, things are changing rapidly right now. This very minute, things are changing. And I don't know where they're going to end up. Um, I've got my own thoughts on some of these, but I'm not wedded to any of these thoughts. I'm like, this is where I think this industry is going. This is the companies I want to buy within that industry, and this is why I'm getting those ones. But I'm very open to the idea that I'm wrong because it's very uncertain. Things are moving really, really quickly. The software that was out even 6 months ago is just not the same software that's out today. And the methodologies and everything that's going into this is just changing so rapidly.
Yeah.
Yeah, it's not a set and forget over months at the moment. And we spoke about saying, I'm throwing away stuff that's 3 weeks old. I did 3 weeks ago because it's like, oh, it's just not important anymore in today's society. So yes, right. So we haven't spoken about wars and Middle East yet. So
well,
I guess
we
probably
should, I
before,
think, and I think
yeah.
one way into it. Let me just
And the RBA.
yeah, well, it's all connected, right? So this
Yeah.
is the Brent futures oil at the moment. You can see it's been, in fact, during the show has been live. It's been gone up against now 82, and that's a bit of a bellwether in terms of the pressure on oil in particular, because of course the Straits of Hormuz are pretty much closed now. The Iranians are chucking missiles around the region. As for why Trump and Israel went now, it's not totally clear. I'm not sure what the full objectives are, and I'm not sure whether anybody fully knows. But this is something which is going to go on for a period of time. The implications clearly are uncertain. Price of gas risen significantly. Now, Michelle Bullock was talking today saying it's too soon yet to know what the implications are, but obviously there is an inflation spike risk, which is probably quite a lot stronger. The RBA was already talking about worrying about inflation. In the US, there's also a concern about inflation there too. And so these wars tend to be inflationary. This type of war potentially could well be inflation because 20% of oil and is not coming. Natural gas, of course, is also there too. In fact, natural gas prices are up very, very significantly in Europe now. Not as high as they were in Ukraine, but we'll see where that goes. Remember what happened then? That created a huge downward pressure on the European economies at that point. So in that context, Michelle Bullock saying it's too soon to know what to do, and we may have to react, etc. Observation: quite often when oil prices spike, interest rates have to go up because inflation goes up. There are a set of unknowns here, other than a level of uncertainty.
Yeah. So, okay, so let's start with the gas. The big issue there is Qatar, Australia, and US are all the three biggest exporters globally. Qatar's got to go through the Straits of Hormuz, so that's where the real pressure is. So could you end up with a similar scenario to Russia coming offline? Yeah, I think it's possible. There's certainly. It's probably not quite as big in terms of the flows. There was a significant amount of gas that really went to Europe via via Russia, but it is coming into a world that's already strained in terms of gas supply. So that's one of the main ones. The biggest thing, as you said, is this uncertainty. I feel as markets probably haven't reacted as much as I thought they would have,
Yeah.
but I think that's partly this thought about, well, could there be if this is a Venezuela situation where Trump goes in, drops some bombs, claims victory, killed the guy I wanted to kill, a new Ayatollah pops up and says a few nice things about Trump and promises one day to give him some oil, and all of a sudden, and not to uh, not to do stuff in the nuclear front, and Trump gets to claim it as huge victory and allows them back into the Iranian oil back into the world trade. Well, actually, all of a sudden we've got the shoe on completely the opposite foot. Could you end up with a Syrian situation where the whole country breaks down and you've got various factions fighting against each other and lobbying? And yes, you could. Could that be one where they've all sort of there's a bit of a detente where they're all like, no, let's just not destroy oil stuff, or let's not pick fights with other countries. Let's just kill ourselves and let the ships flow through. Yep. Could they decide to lob missiles at ships going through the Straits of Hormuz and decide they were going to stay closed? Yep, that could happen as well. Like there's just so many different outcomes from this and so many different timeframes. It could be all over in a week and a half. Trump's got bored and moved on to his next thing. The next, or it could be on, in 18 months' time or 18 years' time, we could still be worried about, things going on. So there is such a wide range of outcomes with this, none of which is knowable. And I think you just need to, even if you think you're aware of what's going on, I think you need to be positioning your portfolio to be aware that you might be wrong, and there can be other things. It wouldn't be going all in on an oil or all out on an oil bet. At this point, to me, it's a hedge risk within your portfolio you need to be taking account of, but it's you shouldn't be sort of assuming this is this is my chance to go. I'm 100% sure it's going to be all over, and so I'm going short oil, or I'm 100% sure it's going to be going on forever, and so I'm going long. I'm buying options on futures, and going all in on oil price going higher. I think there's so many different outcomes from it that can go. And as you said, this stuff does take a while to flow through. But we had a bit of a template for it in terms of what happened with energy in Europe. If it is a long and dragged out, and you're sort of losing this supply for a considerable period of time, is one part. But the other part that I would have hoped the RBA would have learned from that is, what, Australia jacking up interest rates doesn't bring the price of oil down. It's not a lot of benefit for that, and even within Australia is saying, well, so yes, if I do this, then people will use less petrol at the pump. Is like, well, yeah, but it's not going to. They're buying less petrol because they have to pay more off their mortgages. Like, yeah, but it's not bringing down the petrol price for everyone else. We ain't setting the petrol price in Australia.
Mm.
So,
well, we are a receiver, and we've got 35 days according to Bowen. Although I think some would claim a little less, which is rather low relative to other. I mean, Japan's got a year plus, right, of capacity.
Well, we've got a strategic reserve
in the US.
Almost exactly on the opposite side of the planet, in the middle of the country of the US, where you have to pipe it from the middle of the US down to the Gulf Coast, get it on a tanker, and then get it through the Panama Canal and all the way across to Australia to access our. I think that was actually an Angus Taylor one. I think he negotiated that strategic reserve.
I think he probably did. Yes, absolutely. When ScoMo was at the helm, as I recall. So yeah, and the other interesting observation here is, of course, Russia has oil capacity, and in fact is not exporting as much as they did. Now, the idea was that actually that was going to force them to put the price down to generate less revenue to be able to support Ukraine. Well, actually now maybe Russia's going to be able to export more oil because their people are desperate for it. So in a way, what they're doing is potentially stoking Russia's capacity to continue the war in Ukraine.
Yeah, well, and the other thing was, until recently we were bombing some of the Shadow Fleet, which was looking like taking the Shadow Fleet out, which was and so the Shadow Fleet is effectively secondhand ships that have been sold, and they turn off their transponders, and they just they'll go and fill up the oil wherever, and then sail without the transponders on and appear in wherever they're going to go. And so And so the idea behind that was, well, actually, if once a couple of these started being seized, or then all of a sudden the people who owned those ships were like, well, I'm fine with renting out my couple of $1 million boat to somebody to sail illegal oil around. But if there's a 5% chance I might lose my boat, well, maybe I'll go back to something more legal. Maybe I don't want to risk it. And so does that continue? The other thing is, Ukraine, it seems was in the run up to the US election, it seems that the US was sort of basically giving it a bit of a little bit more in the way of weaponry, with a bit of a nudge, nudge. Please don't keep firing at Russian oil refineries, because we really need that oil. We need the oil price to get down, so that because we're about to go into an election. The question is, Ukraine's been a lot more active in that area, and they've actually had a lot more success with some of their drones and taking out Russian oil infrastructure. Uh, is that same thing going to go on? They're busy taking out. Is there a bit of a actually we better give them a few more things so that they can actually let a bit more Russian oil get out in order to one more thing to throw in that whole mix into the soup that is being mixed up. Yeah, energy is a tough one.
Mm.
I'm sort of not taking any major bets either way. Um, I think there's a certain prices where it's like, well, okay, there's prices I'm interested in buying, but at other prices is like, well, maybe I'll yeah, maybe this won't last forever, sorry, maybe this might last a while, but it won't last forever. I think if you're looking at the oil output and saying, oil hits $100 and or whatever, is like, well, I think there's a limited time frame in which oil at $100 is economically viable. And oil at much higher prices, $120 or $130, well, all of a sudden the economics of owning electric cars all of a sudden become way better when oil prices get so much higher. So, there's impetus within that, and pushes, and so in a way, sometimes it's sowing the seeds of its own destruction. Some of the oil prices push too high too quickly. It sort of means that there's a much bigger push into other forms.
Yeah, so I think the conclusion is that there's a lot of unknown unknowns yet. I make the point also, of course, come back to our AI conversation, the AI entities can afford to pay a lot more for energy because it's still a relatively small proportion of what they're investing in relative to everything else, whereas a lot of
Yeah.
households and businesses are already finding those energy costs are quite high. And of
Yeah.
course, in Australia, we had the energy subsidies which were taken away, which means that, of course, the electricity prices are quite a lot higher. Natural gas prices going up would possibly put upward pressure on electricity costs in Australia because of the marginal pricing of electricity and the way that all works, which is another,
Mm.
I would suggest, policy failure in Australia. And I suppose that then puts the question then back on the RBA, because as you say, the RBA is talking about inflationary pressures.
Mm.
And yet, on the other hand, of course, inflationary pressures and oil prices aren't necessarily that strongly correlated, simply because, well, actually, as you say, what can they do about it? Because prices will still go on going up. And that takes us to a broader question then. The Australian economy is looking relatively weak at the moment. We've been very much reliant on government spending, and there's a bit of a debate about how much government spending there is relative to the private sector. And of course, Chalmers has been praising the private sector for their renewed enthusiasm in terms of investment, which is mostly in data centers, by the way, relating to AI. So it's not necessarily that broadly based. But the truth probably is that the Australian economy is a bit exposed to some of these things, and that's why perhaps some of those stocks are looking a little bit weaker compared with previously. On the other hand, of course, we've also got a very strong materials sector, and the price of gold going up. That sector's doing relatively well, and the exchange rates moved. So, how do you sort of play off Australia versus overseas investing at the moment?
Yeah, we're loaded up we're loaded up and loading up more on international, especially given the Aussie dollar's higher.
Yeah.
I think I've got a chart up just showing some of these labor price indexes by sector, and so the blue line is the public sector, and so yes, we're seeing what weak wage growth we do have is being driven very much by that sector, the public rather than the private. The other one I wanted to show was Yeah, this like wages aren't strong. Like this is our wages, we're talking about 3% ish. Um, I don't think that's what's driving inflation in Australia. I do not think wages is there's this whole idea of the cost push and yeah, because wages are running at 3%, therefore inflation needs to run at 3% or above 3%. It's like, no, 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 no. Wages, there's productivity gains out there. Like wages should be growing meaningfully above inflation. And if we look at our real wages, where like they're just going nowhere. Like the RBA projections have us going nowhere. And so yeah, like this is the part where it's so the blue line on this is where we've actually come from in terms of real wages, and the red line is what's in the RBA latest RBA projections. And so like I'm at a loss when they talk about wages. Like I'm just like, guys, we've got no real wage growth. We've got almost zero real wage growth. Sometimes it's negative, sometimes it's slightly above. Wages is not what's causing inflation. What's causing inflation is to me is energy costs, housing costs. And this chart was one of the ones as well on this, like that just points it out as like, so we have this line. So this is asking rents in Australia. And we've obviously from 2021, we're just on this new paradigm. So we've gone from, decades of like this, whatever you want to call it, 20, 30% upward sloping line to a 45-degree line. Now the question is, does that go back to something more normal? Because if that goes back to something more normal, then that's really what's going to help that's going to bring back inflation and the the energy costs. That's the stuff that can bring back inflation. I think bringing down wages, where you point about, you're getting to the point where you're like, just I mean, we've got rent's out of control. We've got all these extra people coming in. We've got no, yeah, we're gonna jack up interest rates, so we'll be building less houses because the developers can't get the finance to build more houses, and that's going to solve our rental solution. It's like, well, I don't know. I think they're on the wrong path, the RBA, and so not to say they're not going to keep raising rates. I think they've got, by the rate of by their logic. Well, first of all, it's pretty rare they've ever done a one and done. So yeah, there's probably at least one more, and then they'll wait a little while, and then even if they think they're wrong, they'll probably do one more, wait a little while, and then say things have changed, and rather than say I was wrong. But I look at their analysis, and I'm just not seeing the same thing they're seeing.
Mhm.
I do not see wages as a problem. They talk about, we've seen a bit of a jump up in job ads, and that's giving us some more hope, and it's like, I don't know. Yeah, we're not on the same page, the RBA and I. So
Well,
I
you
think
talk about the
there's,
same page, Damien. It's interesting that you may have seen in their most recent statement of monetary policy, they've started to talk about an alternative wage price measure that they are preferring to the WPI, which includes superannuation, moving jobs, pay rises, and those things, right? And I'm thinking, well, hang on a moment. Can you really include the 12% superannuation in your wages, right?
yeah, well, and because you can, did we get another 0.5%? I feel like we got another 0.5%, didn't we? We went from 11.5 to 12. I can't
Correct.
remember.
That's exactly right. Yeah.
And so, and so that's the one though. Cameron, you've had Cameron on, haven't you? Cameron Murray.
Yeah.
Yeah, yeah, yeah. That's the one I love from him because everyone always forgets, and I'd forgotten when he brought it up. Was like the reason they brought in superannuation in the first place was because we had too much inflation, and wage inflation in particular. This was
Yes.
a Keating thing, so we had all this wage inflation, and to break the cycle, Keating was like, well, how about we give you the wages, but we just stick it in this superannuation thing over here, so it doesn't like flow into the rest of the economy and go and keep going and pushing. We have this to help solve this sort of wage push inflation thing.
Yeah.
And so they were basically using the argument that, well, no, 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 let's try and back it back in so we can actually say wages are rising, by higher amounts when it's actually being, the whole reason was to take it out in the first place. So yeah. I think there's yes, we're on many things. I'm just not on the same page as the RBA. I just don't. Yeah,
And
I don't know. They're saying different things to me.
And folks, if you want to get that from Cameron, I did have a show with him some time ago where we actually went through into the superannuation question, and he made exactly that point that actually, there was a policy setting way back then, and guess what? Now the RBA is just completely cruel it because of what they're doing.
It's to 100. It's to 180 degree. Yeah.
and by the
thing on how we can treat it.
And by the way, the 2-year yield is now 4.343, right? So that's a a forward view of where rates may or may not go over the next couple of years. I think that's one indicator, but you can see there, compared with where we were back in October at 3.3, we're now
Hmm.
4.3. To me, that's a really important trajectorial change.
Yeah, yeah. So I don't. Well, I think sanity will come back. Sorry, let me put it that way.
You hope.
When I say sanity, the, there's two parts to this. You can be wrong for the right reasons and the wrong reasons.
Yeah.
So sometimes it's the part about, okay, I think they've misread the economy. I don't think they should be raising rates. I think there's it's weaker than what they're saying, and what they've done isn't going to help. Now I could be completely right, and then something else happens. So all of a sudden, we get this sudden wage productivity gain that we never thought was coming, or there's another capex boom in some mineral or whatever it is, and Australia all of a sudden gets lucky, and then we do genuinely need to raise rates because something else happens that was unforeseen, as at right now, and so. I do think there's a part of that where you need to be aware that, look, even if I think I'm right, that's not necessarily the way the path's going to go because things change. And particularly for Australia, outside factors can just have a huge bearing. We're a small economy in a big world, and we're a very open economy. And so we can be affected by other things. And that's what I was saying about before is this idea that, yeah, you want to position your portfolio towards what you think is going to happen, but you need to be very aware of what can other things that can go on. So my personal take is I don't think this is I think the Australian economy, the Aussie dollar is too high. It's factoring in a stronger economy than what we've got. We've got an RBA raising rates when they should be at best keeping it steady. And I do think there is a productivity boom. I think that within the US, in particular, I think there's they are seeing genuine productivity booms, and I think there's a pretty reasonable chance that as much as AI, you can complain, hasn't really done much in the way of productivity, that it is on the cusp of doing a lot in terms of the productivity, and the whole driverless car stuff as well. We haven't really spoken about, but it's not right. It's not quite there, but it's exponentially growing in terms of what they're doing in Waymo and what China's doing. And yeah, it's in very early stages still, but exponential growth, if it keeps growing the way it's growing, can all of a sudden have a huge impact on the rest of the economy as well. And so there's some real productivity, things coming through that could completely shake up what's happening, and I think it will. But I need to be aware as well. There's other things that can happen, and wars and lots of other changes in other countries that could blow that up. And so I'm positioning myself for a lower Aussie dollar, and I do think lower interest rates at some point within Australia. But I'm aware that the RBA is probably going to keep raising for a little while, and there's other factors, and I need to not sort of bet the house on that one outcome.
Absolutely. And I'm fascinated by this inflation debate because, of course, the argument has been, well, the government's caused it because of the big government spending. And if you look at we're $1 trillion in debt or whatever it is now, and that's creating significant impost on the budget going forward. On the other hand, the government says, well, if we hadn't done it, we would have actually had a much weaker economy. The migration question to me is one that should be actually center of mind because migration is creating a lot of the pressures that we're seeing, both inflationary terms. So I've
Yeah.
always argued that migration is itself inflationary, and that is something
Well,
else to think about, right?
and we were kicking this around the saying, well, look, what we really should do is have migration targets that are linked to unemployment and vacancy rates.
Yeah.
Because it's saying, yeah, as long as our vacancy rates are above whatever rate, and as long as our unemployment's, a certain level, then bring as many migrants as you want. Fine. If we've got jobs for them, and sorry, other way around. Unemployment's low enough. If you've got jobs for people and you've got places for them to live, bring as many as you like. But the flip side is when you haven't got the jobs and you've got nowhere for them to live, now do you want to bring, as many? And this is a chart. I actually forgot to put the source on this one. I think I pulled it off the macro business site, but I thought this is a fascinating one. So this is within Australia. It's administered prices, which is utilities, property rates, childcare, health, all the things that governments have pricing power over, and then the market goods and services. And so you're like, well, where's our inflation coming from? I don't know. It seems pretty obvious.
Absolutely, yes. The government seems to be partly, and these administrative prices. It's interesting in the UK, they have just decided to take out from the composite energy price the costs of greening households and insulation and those things, which were policy things that were put into the electricity price some years ago. And that means
Mm.
that everybody in the UK is going to see their electricity on average come down about 100 or energy £150 a year simply because of that policy change. And actually,
Mm.
when you look at the construction of the energy price, both in Australia and in the UK, a lot of it is not just the raw material. A lot of it is
Oh,
all of this
yeah.
policy stuff like, differential pricing and marginal pricing, and everybody gets paid this amount if, in fact, you need to bid more to be able to actually get the capacity you want. The policy
Mm.
settings, both in the
Mm.
UK and in Australia, have messed massively with the price of energy.
Yes. And more importantly, we've sold to me, well, not more importantly, just as important, we've sold monopoly assets,
Yeah.
and then we spent all this time setting up systems to like, regulatory boards and rules about what they can do and what they can't do. And then they all work out the way around whatever the latest rules are. We see energy prices going up, and then all of a sudden they work out what's happening, and they have some review, and we go back and we set some new rules, and then everything gets reset for a year or two, and then they go back to this whole. But this is all because we sold monopoly assets to people. To independent players who are trying to roll the system. They're trying to make as much as they can out of it. When you look at the amount of transmission that goes into a lot of this stuff, and most of the transmission's been sold to private players, and so whenever you have a review and you say, well, why is our electricity prices so high? Oh, we need more transmission. We need more transmission. Yeah, I need to build. I need to go out and build more and get more regulated assets and make more money under this. And so, I'm not saying you don't need in that particular case, but I definitely um, I think the nuance of the energy debate to me is that the cheapest energy is the energy that's already connected to the grid. Now, I don't care if you're solar, wind, whatever it is, you come up with that. You've already done your connections. It's cheaper to put new ones on there. And a lot of the problem we've got now is it does need to be built further away or needs more transmission or things like that. And so that's where this debate comes about. Oh, look at this some coal-fired power plant that's cheaper than having to build a wind turbine 200 kilometers in that direction. It's like, well, yeah, but if you have to build a new coal-fired plant somewhere in 100 kilometers away, or where somebody's happy to have it there, then all of a sudden those costs need the transmission lines as well. And I think that's sort of, there's a lot that's going to be lost in that nuance of the debate around um, that whole energy. And we've obviously got people that are willing to try and mess things up for their own good. They're
Oh,
like,
really?
sorry,
Vest,
muddy the
vest,
waters for their own. Yeah,
vested interest getting in the way. I've
yeah,
never heard of that.
exactly.
And as Talk the Talk says, Snowy Mountain. Yes, of course, the cost of Snowy Mountain 2 is now accelerating away like you wouldn't believe. And it's
Mm.
interesting that there's been a little bit of debate in the chat about, well, maybe we should price everything in gold, because actually house prices necessarily in gold haven't gone up dramatically, right? Now we've had this
Yep.
discussion previously, right,
Yeah, yeah.
on the relationship between gold and everything else. I don't want to rehash that conversation, but I would say that it does depend on where you think your value anchor is, right? Because if you do believe that gold is the hook on which everything else pivots, well, then your strategy will be one thing. If you have a different view of where you think your value anchor is, and maybe it's the US dollar or something else, you have a different set of strategies. And that actually is more broadly a really important debate, isn't it, about where you think value actually lays?
Yeah, that's right. I think for me, it comes back to some sort of unit of work that you sort of go, well, if you work an hour and you get paid whatever, and what are prices of things you can buy for that hour of work. Now that's interesting and there's lots of stuff that'll come back to talking about that. But then the flip side of that is, well, there's people who did who did work, years ago and have this accumulated savings, and whether that's in gold or it's in property or it's in cash or whatever it is, or stocks or shares. And then they've obviously got a different idea about, well, the work I did now was worth of work 20 years ago, and I've saved it, and it's now doubled and tripled, and so now I want to be able to buy more with that. And so yeah, it's a time frame debate for everyone in terms of saying, is this an hour you just did yesterday, or is this an hour that I did and I've saved it and I've compounded it and grown it and leveraged it, and now I want to collect on whatever it is I'm buying. So
Well,
I'm going to steer clear of this one, because I just think the gold debate. Let's Not that I don't want to have it. We have had it before in the past, and we'll have it again. But it'll be there's another hour and a half gone. We've already been at this for an hour and a half, and I think we can
absolutely
easily
right.
go another hour and a half.
No, spot on. Absolutely. Well, I think that's probably a good place to draw the bow in this conversation. But I think I just want to leave you with this thought, Damien. I think we're going to see a lot of volatility on markets over the next little while, right? Probably.
You can just tape this little segment. You can play that at the end of every one of our next statements for
correct.
the next couple of years.
I was going to say, in a way, what's new? This will continue. So, separating signal from noise, understanding what's really going on versus what the talking heads are saying or what social media is suggesting is really quite important. And I would generally say history shows that sometimes people can overreact to the short term. If you are actually an investor and you're actually building wealth for your long-term future, sometimes it's important to look through those very short-term inflections. But sometimes there are significant changes in trajectory which are significant and important to understand. And what we're trying to do, I suppose, here is to highlight where some of those may be. And we're going to do more of that, because guess what? We're only into March and we've already had a year's worth of stuff to go through, right? So I think it will continue.
Yes. Absolutely. Yep, good note to finish on. And I guess the thing I'd note with all this volatility, the thing is, you got to have a plan before you go into this. You can't sort of go in and go, oh my God, oil prices all of a sudden just shot up. I need to rush out and buy oil stocks. It's more about saying, okay, if this, I'm aware of the fact that Trump's been threatening Iran or whatever it is, and now we're at the point where, if this is something that's going to be long and drawn out, and we're going back into a Ukraine-Russia type scenario where we see these spiking energy prices over a course of a couple of years, then I have a playbook of this is what my plan is to get through that, and these are the types of stock I want. If it's all over tomorrow because Trump's suddenly been interested in something else, or he's received a bribe, or whatever it is that's happened, and it's all over, and there's more. Okay, this is what I'm doing at these levels. I'm interested. I'm thinking the oil price is going to fall, but if it falls this far, I'm interested in buying. There's those types of thoughts you should have before it. Rather than sitting trying to react to the latest. Is like, well, what's my scenarios? What do I want to buy? What are the stocks that I really, what are the types of stocks I want to own? And at what prices do I just go, look, I don't know how far it's going to fall, but actually this is a great price to be buying it. And so I've certainly got, within our universe, there's stocks where it's like, well, I think this is great, high quality stock. I don't think it's going to be disrupted by AI. And if it halves in price tomorrow, I'm going to be concerned, because, it's a stock I think shouldn't have halved, but I'm going to be out there. I'm going to be out buying it, unless I can see, something else, some sort of fire behind the smoke. But, there's opportunities being thrown out. And particularly as we saw, the whole software sector got hit. The banking financial sector, like you're going to go through one by one, and different sectors are going to get hit by the theme du jour is about saying, well, okay, when that happens, these are the banks I want to be buying, or these are the software stocks, or these are the material stocks I want to be buying at that point.
Absolutely. And we didn't get into private credit, which is the whole nother ball game, but that's be for another conversation.
Can we just touch, I think it's worth touching just really quickly on that, because I had the blue owl is that poster child for it, isn't it? Is that the one you wanted to talk about?
Blue Owl and BlackRock's just announced that they've had 7% withdrawals from their fund, and there was a UK fund that actually fell over, and basically the credit agency there discovered that they'd actually double leveraged their assets.
Yes. So this private credit. Oh God, yeah, we should have. This was what I did want to talk about. Sorry, this isn't the private credit chart. Let me pull up. No, actually, I don't have anything to show on it. Let me just talk about it.
Okay.
Okay. So there's lots of issues around this. One is it's the fact you don't know what's going on. That's the real thing with the private credit. There's stuff going on there that we just don't know how bad it is. The other thing is these funds can get locked up. So if you're invested in these, and this is part of the issue of the blue owl ones, they're probably all right. I don't know. They've been investing in data centers. I think they're probably fine, but they've had so many people taking their money out that now they've locked up and said nobody can get their money back. Now that's only a short-term thing. They'll sell off the assets or they'll do whatever it is, and eventually people will get their money back on it. It's not like this thing's gone to nothing and they're locking it up because it's not there. But it's similar to a lot of property trust funds during the financial crisis. And the issue is for people is, well, if I need that money, I can't get it. And this is why these things should be a small part of your asset portfolio if you want them at all. Is you shouldn't have 60 or 70% of your money in there, and then all of a sudden, it's all locked up. I'm going to be getting money back, but it's going to take me 5 or 10 years to get the money back as they finally get paid back their loans. And I need it suddenly because whatever, somebody's getting married or there's an operation or whatever it is. It should be a small part of your portfolio. Is there problems in this sector? I think there probably are. I think it's going to be big at some point. If you said to me it could be 5 years away, I'd be like, yeah, sure, it could be 5 years away. It could be 5 months away. I think it's probably closer to 5 years than 5 months. But could you have enough events happen in sequentially and to see things blow up? Yeah. I think Trump in particular has loosened the regulation on the selling of these. I think that's part of the reason why I think it's probably 5 years, closer to 5 years and 5 months, in that now they can sell it to more people, and so now they will. And so there'll be people wanting to get out, but they'll be trying to sell that to new retail investors. Oh, this is finally a chance to get, Martin, you haven't been allowed to buy this assets now. Finally, we're letting you buy this stuff just as it's all falling apart. So I think that's one area I think there's problems, and but are they imminent problems? I'm not convinced. I think this is a bubble which will blow bigger before it finally collapses. I suspect, but if the wrong sequence of events could see a run on these assets, absolutely. And I do think is it big enough to bring down financial sectors and financial systems and all that? Probably not at the point. It's probably enough to make some indigestion, and cause some problems. But it's not at the sort of, whereas, pre the financial crisis, once you'd seen the level of all these debts that were behind it, if this thing comes down, it's bringing a lot down with it. Whereas I think at the moment where it's significant, if they all started falling over, going to cause some significant problems, but it's not. I think it'll grow bigger first before we finally see some sort of collapse in it.
Yeah, and Jamie Dimon talked about the cockroaches. You don't necessarily find one, you tend to find a few, and they turn over another stone, then there'll be some more. So I would expect to see a drip, drip, drip of more news in this sector ahead. And as you say, if you are actually somebody who is wanting and needing a bit of liquidity in your portfolio, remember that you may find that some of these undisclosed private areas are very difficult to liquidate when you need to. So just be a little bit cautious in the short term.
Yeah, let's talk more about the private debt next time. Actually, we just did, because I think it is an important one. I've got lots more to say, and I feel like I should, but I'm like, it'll be 10 o'clock.
No. I think we've probably we've met our mandate today. Damien, thank you so much as always. Yes. Really appreciate it. I look forward to catching up with you again next month, and I'll take you off stream and close the show.
See you later.
Cheers. There you go. Well, I hope you found that interesting, hopefully informative, and maybe a little entertaining too. Check out the recorded shows. We put them up every day of the week. Next week, it'll be me. I'll be back on for my live show, and I'll be going through the latest with the housing and finance data and looking at my surveys and trying to look at some of the maps that we've created to show some of the differences in different parts of the country. So check that out. And I will be posting a brief summary of my latest stress data in the next few days ahead as well. So thank you very much for that. The dogs are here. Hardly moved, so that's quite good. And they'll be now taking their lunch and walk. And I will wish you the very best for your Tuesday evening. Thank you very much for watching. Take care. We look forward to seeing you on the next show. And Jason, thank you once again for your support. Really appreciate it via the super chat. Makes a huge difference. Take care. See you next time. This is Martin North from Digital Finance Analytics signing off. Bye.